Every few decades, finance quietly swaps out its operating system. In the 1870s, it was railroads stitched to bond houses, metal and paper teaching each other new tricks. In the 1940s, it was Bretton Woods, the dollar-crowned king in gold demoted to symbolism. In the 1990s, the browser turned market data into oxygen and retail into a movement. The next swap is already underway, and by 2030, the market stack you take for granted will feel alien. Not because money disappears, but because markets move down the stack into identity compute, power, and code. The question isn't if this happens, it's who captures the toll booths along the way. This is where money, power, and history collide, and nothing is as simple as it looks. Debt and equity are costumes. Underneath them are ledgers, wires, contracts, and a political promise that tomorrow will arrive roughly on schedule. The old stack was paper promises dressed in software. The new stack is software that mints the promise, roots it, measures it, and if necessary cancels it in real time. That's progress to some, surveillance to others, and the truth sits uncomfortably in between. By 2030, the most valuable markets won't just trade assets. They'll trade trust itself, credentialed identity, verifiable collateral, kilowatt hours, GPU hours, and machine-readable risk. 5 bets define that stack, not prophecies. Operating assumptions start at the public core, where states stop being narrators and become platforms. In the 20th century, central banks told stories with rates and speeches and carefully staged crisis theater. In the 21st, they expose APIs. Real-time rails aren't fintech flair anymore. They're plumbing. Finality in seconds is table stakes. Government money that used to drift through a maze of batch files, correspondent banks, settlement windows, and reconciliation errors is compressed into a single programmable flow. Not meme coins at the coffee counter. Policy-grade objects at the heart of payroll, tax, benefits, and wholesale settlement. The instrument isn't just a balance. It's rules wrapped in code. Who can hold it? When it can move, what disclosures must accompany it? Which sanctions flip the switch and freeze the river? History saw this pattern before. In 1694, the Bank of England didn't just issue bonds, it built a platform that fused sovereign promises to private balance sheets. The eurodollar market did the same in the 1960s, offshore logic riding onshore credibility until those dollars felt more real than the ones in the vault. Each time the public core hardened into a standard, private innovation exploded on top. Each time, dependence deepened. If you can export rails, you export policy. If you can't, you rent both. That is the quiet contest of the next decade, which sovereignties become exporters of settlement and which become importers of permission. Winners here specialize in code that looks boring on a demo day and revolutionary in payroll, compliance that composes with custody, tax that settles with wages, benefits that accrue as money moves. Call it policyware. The losers are the middlemen whose business was paperwork, reconciliation as a profit center, delay as a moat, obscurity as privacy. Privacy by obscurity dies when the base layer is programmable. Opacity doesn't vanish, but it becomes a setting you have to defend rather than a default you can hide behind. Democracy decides who governs, markets decide who survives. Make base money programmable and it tilts both. Now climb one layer to collateral, because collateral always eats the world. The most traded asset of the 2010s wasn't oil, wheat, or shares of a social network. It was trust in safe collateral, short-term sovereign paper, reserves that felt like steel. By 2030, that trust is productized. Everything becomes a wrapper. The wrapper is the new exchange. It doesn't matter if the ledger is on-chain or off-chain. What matters is that the asset knows its own rules, presents them to counterparties, and can prove its own history without sending you a 100-page PDF. Weekend risk will look like a quaint superstition. Corporate treasuries that used to hold their breath from Friday close to Monday open will demand cash-like wrappers that reconcile continuously, prove reserves and liabilities in the same breath, and refuse to move if a risk limit is breached. The line between custody and exchange blurs. Private credit, trade finance, and receivables will look less like bespoke relationships and more like machine-verifiable claims with lifecycle metadata. Who originated, who serviced, who attested, and when the revenue actually hit. A receivable that can't prove where it's been will trade like a rumor. A receivable that will trade like cash at a price. Again, history rhymes. In the 19th century, railroads transformed iron and land into bondable collateral. In the 1980s, homes and the income streams attached to them became tranchable collateral. Structure beat substance until it didn't, and when it didn't, we learned the cost of complexity without transparency. The next turn is composable collateral. Eligibility criteria, haircuts, and rehypothecation limits coded up front rather than negotiated in the fog. Settlement risk drops from days to blocks. Frictions vanish. So do excuses. That we know a guy. Lending edge dies in a world where cash flows are signed and service history is auditable. The spread to watch is the wrapper basis. Identical assets under different rule sets and latencies priced just differently enough to feed an industry. There's a quiet danger hiding here. If collateral becomes infinitely composable, so does contagion. The same rails that eliminate T plus 2 can deliver T plus 2 fast. Circuit breakers matter when your problem isn't that nothing moves. It's that everything moves at once. Underneath that, another market wakes up. If data was the new oil, compute is the refinery, and power is the pipeline. By 2030, electrons in GPUs behave like currencies. They're not metaphors. They're units of capacity you can promise, hedge, and deliver, or fail to deliver and pay the basis. We will see long-dated compute forwards. Capacity reservations for specific chips in specific regions with verifiable uptime SLAs. They'll settle financially most days and physically when the chips hit the dock. Miss your delivery window and the spread punishes you, like any commodity contract that discovered reality late. On the energy side, power purchase agreements rebundle into standard blocks aligned with data center loads. The once esoteric vocabulary of curtailment risk, demand response, heat recapture, and water constraints moves from footnotes into term sheets. The AI supply chain, the orchestra of models, weights, tokens, datasets, training windows, and inference loads, acquires yield curves. Some will go long training and short inference. Others will do the opposite, depending on silicon cycles, model architectures, and power availability. You can dismiss this as financialization until a model launch slips 3 months because megawatts didn't warranty clear. At that moment, you realize markets weren't optional. They were the missing transmission line. We've traveled this path. The 1970s taught the world to price energy shocks. The 2000s turned bandwidth into capacity you could contract. Railroads collateralized steel and time. Telegraphs monetized latency. The obvious next step is that compute capacity becomes collateral you can pledge, and power becomes the risk that defines your cost of capital. Regions that can clear new electrons cheaply and cleanly will capture the margin. Regions that can't will rent the future at a premium. And the most durable alpha will live in places that don ET trend on social media. Thermal efficiency, cooling innovation, grid interconnection diligence. It's not sexy, it's profitable. Identity then steps out of the shadows. Credit used to be a handshake, then a file, then a score that pretended to be objective. By 2030, reputation becomes a signed graph. A web of machine-verifiable claims that travels with you, and prices risk at the edge. Verifiable credentials sound like jargon until your onboarding collapses from weeks to minutes, because your history arrives with signatures from issuers that matter. The school that trained you, the board that licensed you, the employer that paid you, the regulator that audited you, the organization that certified your compliance training just last month. Not portable PDFs. Claims that can be checked without calling anyone, revoked without guesswork, and composed without an army of paralegals. Small firms and creators don't just present resumes. They issue revenue share claims gated by these credentials. Investors subscribe to skill streams with programmed clawbacks if metrics fall below agreed thresholds. Suddenly, the financing of human capital stops pretending to be philanthropy or luck. It becomes underwritable. KYB and KYC, the bureaucracies that measured their own power in weeks, compressed to minutes, not because anyone relaxed, but because proofs replaced promises. The question, who are you? Only becomes a query against a revocation registry. The answer, may you do this, returns as a yes or no, not a stack of scanned documents that someone might read on Tuesday. Passports turned borders into policies. FICO turned uncertainty into underwriting. The next step is portable attestations that let markets price you. Your uptime, your custody standards, your safety protocols, your delivery history, without strip searching your life. That can be liberating. It can also harden gatekeeping in code. The outcome isn't predetermined. Design decides. The winners here operate the boring but essential institutions of the new age: revocation registries, slashing rules, privacy-preserving queries, credential wallets that don't leak. The losers are the shadow markets and stolen data, and the middlemen who sell resumes as a service. Now complete the loop with risk. Insurance was invented to turn catastrophe into math. Derivatives turned math into markets. Sensors, telemetry, and cryptographic proofs are about to turn markets into automata, risk machines that pay when the world crosses a line. Parametric cover used to be a curiosity for farmers and typhoon belts. It becomes mainstream when measurements outpace litigation. A flood exceeds a certain height. A wind gauge records a certain speed. A cyber system goes dark for a certain number of minutes. An escrow releases. No adjusters, no arguments, no multi-month voyage through the theater of claims. The measurement is the trigger. The trigger is the contract. Cyber markets begin to resemble weather markets. Portfolios of vulnerabilities, patch cadences, exploit windows, and recovery times priced continuously. If that sounds dystopian, your risk on sale by the hour, recall we already do this for storms. We just pretend it's different because clouds feel old and code feels new. Firms and cities will post resilience bounties. If you raise the seawall, add redundancy. Prove it with signed telemetry. Your premium drops now, not at renewal. Capital does what it always does. It flows downhill to where risk is measured, priced, and managed in real time. A brutal truth arrives with it. When payouts are automatic, selection effects are automatic too. Risk doesn't disappear. It routes to whoever is least measured, least credentialed, least able to produce the proofs the market demands. The victims will not always be foolish. They will often be invisible. Stack these layers and you get the new market OS. The programmable public core moves money with rules baked in. Collateral wrappers sit on top and give claims a body you can audit. The energy compute basis supplies a spine made of electrons and GPUs that can be promised and policed. The reputation graph prices counterparties at the edge so you can transact with strangers safely. Parametric risk closes the loop so capital can sleep at night. The result is markets that converge on physics and proofs. Fewer trust me's, more verify this. Faster booms because friction is gone. Sharper busts because feedback loops are tight. And the oldest human problem remaining untouched. Power accumulates where rules are written. The fault lines are obvious once you care to look. Privacy first, programmable money, and signed credentials make who are you? And may you do this? Trivial to check at scale. They also make abuse trivial to scale. Slogans won't save you. Technical minimization will. Zero-knowledge proofs, selective disclosure, architectures that let you convince without confessing. Resilience next. Instant settlement vaporizes counterparty risk and replaces it with liquidity whiplash. Crises will compress in time and amplify in amplitude. We will constitutionalize circuit breakers the way we constitutionalize central banks. Geopolitics again. Stacks fragment. Blocks export rails as policy. Interoperability stops being an engineering choice and becomes a diplomatic act. Labor doesn't escape. Skills atomize. That's good for mobility and brutal for the uncredentialed. Education providers stop pretending they sell lectures. They become issuers of yield-bearing identity. Some will treat people like partners, their credential streams a shared asset. Others will treat them like products, their graph of a captive ecosystem. The environment gets louder, not quieter. The energy compute boom is physics, not vibes. Regions that clear clean electrons and reuse waste heat take the margin. Regions that don't will import capacity and export capital. If you're building or allocating, the playbook is simple to say and hard to execute. Bet on attestation. If a claim can be signed, it will be traded. Every market in the new stack privileges the party who can prove. Own the pipes that verify. Design for custody. Assets that can settle instantly still have to be held safely. And safety in this era includes proving liabilities alongside reserves. Arbitrage, the wrapper basis. The same asset under two rule sets will trade at two prices. Capture that spread with rigor, not vibes. Verticalize physics. If your product depends on power and compute, own as much of that chain as your balance sheet allows. Metering, cooling, interconnection. This is where the advantage hides. Instrument resilience. If an action reduces measured risk, it should reduce cost of capital now, not at the end of the insurance year. Build the switch that turns telemetry into cheaper funding. Expect the winners to sound boring. Revocation registries, reconciliation engines, metering systems, audit-friendly custody. The frontier always looks exotic from afar and familiar up close. In frontier markets, boring is leverage. What breaks first? Systems designed for latency. Bureaucracies that monetize delay. Brands that survive by vibe rather than proof. The rhetoric will be predictable. Politicians will promise inclusion. Founders will promise efficiency. Investors will promise yield. The stack will deliver some mix of all three for someone. The distribution will be uneven. It always is. And the line between enabling freedom and enforcing order will be drawn where code meets policy, then moved by whoever wins the next election, then hardened by whoever writes the next standard. If this sounds grand, remember how mundane these shifts feel once they arrive. The browser was a curiosity until it was oxygen. Real-time payments were a pilot program until your landlord refused to wait for Friday. The market stack changes slowly, then all at once, then permanently. And the pieces are visible already in the wild. Instant rails that settle in seconds, custody that proves reserves live, chips that rent by the minute, cities with sensors wired to insurance pools, resumes replaced by signed credentials. You don't need clairvoyance. You need a tolerance for the obvious, stated early and defended patiently. By 2030, the market stack won't look like Wall Street Plus apps. It will feel like infrastructure that prices truth, who you are, what you own, what you can deliver, and whether the world just crossed a line. That should excite you. It should also scare you, because truth priced at machine speed creates new freedoms and new fragilities. It creates markets where merit travels farther and markets where mistakes calcify faster. It rewards those who can prove and punishes those who can't. The task is to build a version of this stack that respects human dignity without sacrificing operational sanity. The risk is that we don't, and settle for a version that's efficient for the powerful and precise for the compliant. So choose your position while the rules are still wet. Upstream writing standards, midstream routing flows, downstream paying fees. The toll booths are going to be built by someone. If you can't be the state, be the standard. If you can't be the standard, be the switch. If you can't be the switch, at least know which side of it you stand on. Because by the time the new operating system feels normal, the margins will already be spoken for. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.